Hi everybody, Andre again here from the financial statement story.com, and this is your tool which we call Global Financial Bridge that allows you to take your financial statements and communicate your story in order to improve our profitability, our cash and our returns. So with no further ado, let's get on to it. The first thing we have is our income statement and balance sheet, all brought into us either through our Excel import or directly keyed in. It just takes a few minutes to do that. And we simply take these statements and convert it into our one-page scorecard. This allows us to look at our income statement and our balance sheet and integrate the way we manage our income statement and our balance sheet into the 5 key chapters of our financial statement story. So for those of you who have been part of our podcast system, hopefully you remember the key chapters. The first thing we want to do is identify in chapter 1, how well are we growing? In chapter 2, we want to take growth and convert growth into superior profitability. And then in chapter 3, we want to place the rigor on the management of the balance sheet with specific focus on our working capital. And then of course, chapter 4 tells us about how effectively we're managing those first 3 chapters and how we're converting that into good or bad cash. And then lastly, this is all about the way we create value. In other words, the return on capital that we have employed in our business. So now we're in a place to tell our story. Well, first of all, we've grown our business by some 12.5%. Have we translated that growth into superior profitability? Well, previously we were making about 6 cents per revenue dollar. Today, our profitability is in slight decline to 5.5 cents. From chapter 3's perspective, or the way we're managing our balance sheet, our working capital tells us that for every dollar of revenue, we used to consume nearly 22 cents worth of working capital. Today, we're consuming 28 cents worth of working capital per dollar of revenue. So our balance sheets become more hungry. And what are we looking for? We're looking for a lean, mean balance sheet machine. Remember that. Lean, mean balance sheet machine. What we've got is completely the opposite. And then, of course, chapter 4 tells us that we have consumed $951,000 of cash for the given period. And lastly, in chapter 5, well, what this tells us is that the return on our invested dollar was some 20 cents previously. Today, it's a little bit down to 15 cents. So is this good growth? Well, our vice president of sales walks in and says, you know, guys, I'm starting to understand what this is all about. However, what's the problem? The problem is that our goal was to grow by 15%, not 12.5%. And if we achieved that goal, we would have significantly improved our profitability. And I'm sure all those other things would have improved as well. Definitely cash. Well, let's have a look and see if the assumptions of our vice president of sales is in fact correct. All we do is we take that 12.5% growth and convert it into our 15%. This is what our business would look like based on the assumptions that have been presented by our vice president of sales. So, are his assumptions accurate? Well, I think for most of us, it's very difficult to say. So what we need is a communication system. We need to be able to isolate the impact of a decision and see how that decision actually translates to better profit, better cash, and better returns. And the way we do that is we make a change and we simply press the net change button. What this shows us is an additional 2.5% growth. So the net impact from 12.5% to 15%. What will that do to our business? Well, it means that we have to grow our revenue by $424,000, and that will produce a operating profit benefit of some $82,000. So now we're in a position to evaluate the impact of this additional growth. Well, it will improve our profitability by some 0.3 cents per revenue dollar. However, we require a cash investment of $37,000 to do so. So we are actually cash absorbing when we grow. Why is this happening? Well, simply we go straight into our reporting and into our cash management system. What this does for us is this shows us how to manage cash based on three key environments: our actual cash flow, our what-if cash flow, and the net impact of doing something to our business. So in this case, what would have happened if we could grow our business by that additional $424,000, and the key reasons why this will create a $37,000 additional cash requirement when we grow. And when we have some more time, it's very easy for us to sit down and explain those key reasons, and this is the space to do so. So let's move on. Well, now that we're starting to get a feel for how our business either generates cash when we grow or absorbs cash when we grow, we're now in a picture to investigate each one of those key stories. So we simply get out of there, and I'm going to press this little undo button to return to our original numbers. Let's quickly investigate chapter 2 of our story. Simply by opening up our profitability box, we get into an environment where we can see all the key things that we need to do in order to optimize chapter 2 of our story. And the first thing we notice is that our margins have gone from about nearly 27 cents to just under 25 cents. So this would have a very significant impact. However, how much would that impact be? Let's quickly have a look. Well, previously, our direct input costs were 73 cents. So all I'm going to do is I'm going to do a what if and see what impact would we have had on the business if we did not have that margin destruction. Let's have a quick look. Well, from this viewpoint, what we notice is that if we didn't reduce our margins by 2%, we would have improved our operating profit performance by some $416,000 and our cash flow performance by nearly $500,000. So if we didn't allow for that margin destruction in order to achieve this growth, we would have had $500,000 more cash in the bank today. Back to our scorecard, press the undo button, and for the sake of brevity, for this little presentation, what we can also notice and do all our investigation on is how our costs behave and how our costs are changing with changes in volume and whether that's working for us or working against us. Moving on to working capital. What this is all about are the key components of our working capital, and for our ability to understand how those components impact our balance sheet and obviously Chapter 4 being our cash flow. But to do so, what I want to do is I want to take us out of the complexity of the everyday balance sheet and convert the balance sheet into our wealth creation engine. And what this allows us to do is to easily identify how we are managing our balance sheet. So this converts the traditional balance sheet into really two key areas: how we fund our business and how we use those funds to invest inside our business. And as you can see, we are using about $5.3 million worth of working capital. We have about $425,000 cash in the bank, and our other non-cash assets are sitting at about $1.2 million. So that gives us a quick overview of how we're using our funds. And then we notice that our receivable management has gone from 49 days to 58 days. So how did that impact our business? Well, let's bring our receivables just back to what they used to be and see how that would impact both our cash and our balance sheet. Well, that 9 days, the fact that our receivable management or our credit management system has actually degraded by 9 days means that we have forfeited about $481,000 of cash. In other words, if we could have kept same profit, same growth, and managed our receivables the same way that we traditionally have, no improvement, we would have had $481,000 more in the bank today. Very significant. So what we now can see is how we can use our various ways of how we've managed our business in order to create those improvements. And then lastly, of course, we can see cash, and there's so much to talk about cash, so we won't do that in this very short space of time that we have, and hopefully through our training and through the use of the capability, we're going to get really familiar with the king in chapter 4. And then lastly, what is return? Return is all about how we manage the income statement and the balance sheet. And once again, we're going to look at the techniques that we deploy in order to optimize the return on each invested dollar. So that is the way that we would use our one-page scorecard to drive any form of decision. And more importantly, if the decisions don't only relate to the actual metric, they may relate to the number. We can change the number and we can do our what if that way as well. So this allows us to have a quick look and see how certain strategies would impact our performance based on changing either the income statement number or the balance sheet number or any one of those relationships. Okay, so let's move out of that. Let's go to our data screen to see how we can now evaluate our future strategy. So now, as you can see, we've only got 2 periods in here, and as you know, we may have as many periods as we wish. So what we're wanting to do is we want to look at how we can use our financial statements and integrate our strategic thinking into our future financial statements. And in this case, we can prepare a budget for a month, a quarter, 6 months, whatever the case may be. I'm just going to do a quick 12-month budget just to give you a feel for how it's done. Well, essentially, these are the key drivers to our strategic thinking. So last year, we grew by 12.5%, and after much consideration, we're going to slow the growth down a little bit to something like 10%. And the focus here is going to be more on margin management. We can improve our margins slightly, and our variable costs are going to stay pretty much the same. Our fixed costs, well, we're going to increase some of our cost structures with more salespeople, etc. So that's going to be something like $2.7 million. And our depreciation is going to increase a little bit. Why? Because we have a little capital expenditure program. Our average cost of debt will stay the same at about 5%. Our receivable management, that definitely has to improve to 50 days. Inventories, yes, or work in progress, whichever business type you're in, that's going to go down to 70 days because we're going to have another very important strategy on that, and our payable days will stay the same. And as we said, we gave a capital expenditure program of something like $200,000 next year. All right, for new technology, etc. Okay, so there are our key strategic inputs. This is the financial statement outcome, and now we're in a place to be able to evaluate our strategy based on our one-page scorecard. There is our future income statement. Here is our balance sheet. And this is the result of our strategic thinking. Less growth, improved profitability, significant improvement in our working capital management, producing a very, very efficient cash flow and delivering good returns. And what this also now allows us to do is to, impute some of those things. Well, hopefully now we can give our shareholders a distribution, and our distribution is going to be $500,000. We're going to impute the impact on tax. So we're going to change our tax input a tax rate of, let's call it 35%, just to get a feel for how tax will impact our financials. And even after our taxes and after our additional distribution to our owners, we're still cash positive. So that all works out very, very well for us. And this is going to be the platform for our future strategic thinking. So I'm going to update that. And as you can see, that brings it right into our system. And this allows us to, identify a whole range of different reporting mechanisms for the future. And the income statements, our balance sheets, our management balance sheets, cash flows, and the various workings behind that, our key performance indicators, etc. Nicely established for us. All right, it is Andre Guillen talking about Global Financial Bridge. This is the system that is going to enable you to truly take your financial statements and create significant performance inside your business with this tool. Please have a look at it, and hopefully we can go to the next phase with this. All the best. Bye for now.